Hello and welcome to Building Investors. Today, we embark on an exciting journey into the world of the stock market. If you're a beginner looking to understand the basics, you're in the right place. Segment 1. Understanding the stock market. Let's start with the fundamentals. What exactly is the stock market? It's a place where shares of publicly traded companies are bought and sold. Think of it as a giant marketplace for ownership in businesses. Segment 2. Why invest in stocks? Why should you consider investing in stocks? Stocks have historically provided excellent returns over the long term. They offer a chance to participate in a company's success and can help you grow your wealth. Segment 3. Types of stocks. Stocks come in various flavors. We have common stocks, preferred stocks, and even different classes of common stocks. Each type has its characteristics and potential benefits. Segment 4. How to buy stocks. Wondering how to buy stocks? We'll explore brokerage accounts, stock exchanges, and the process of placing your first stock order. Buying stocks can be a straightforward process. Here's a simplified step-by-step guide. Step 1. Educate yourself before buying stocks. Take some time to educate yourself about how the stock market works. Understand basic concepts like stocks, dividends, and how stock prices fluctuate. Step 2. Set clear financial goals. Determine why you want to buy stocks. Are you looking to save for retirement, build wealth, or achieve short-term financial goals? Your goals will influence your investment strategy. Step 3. Choose a brokerage account. You'll need a brokerage account to buy and sell stocks. Popular online brokerages include E*TRADE, TD Ameritrade, Charles Schwab, and Robinhood. Choose one that suits your needs. Step 4. Open your account. Visit the brokerage's website and follow the steps to open your account. You'll need to provide personal information, financial details, and identification. Step 5. Deposit funds. Transfer money from your bank account into your brokerage account. This is the money you'll use to buy stocks. Step 6. Research stocks. Use your brokerage's research tools to find stocks that align with your investment goals. Look for companies you believe will perform well in the future. Step 7. Place an order. Once you've identified a stock to buy, place an order through your brokerage's trading platform. There are two common types of orders. Market order. This instructs your broker to buy the stock at the current market price. It's executed immediately. Limit order. With this order, you set a specific price at which you're willing to buy the stock. It may not be executed if the stock doesn't reach your specified price. Step 8. Review and confirm. Before finalizing your order, review the details to ensure they are accurate. Double-check the stock symbol, the number of shares, and the order type. Step 9. Monitor your investments after purchasing stocks. Keep an eye on your portfolio's performance. You can log into your brokerage account to track your holdings and see how they're doing. Step 10. Consider a diverse portfolio to manage risk. Consider diversifying your investments. Don't put all your money into one stock. Instead, spread it across different stocks or investment types. Step 11. Stay informed. Keep up with financial news and any updates about the companies you've invested in. This information can help you make informed decisions about buying or selling stocks. Step 12. Patience and long-term thinking. Stock market investing is a long-term game. Don't panic if your investments fluctuate in the short term. Stick to your investment strategy and goals. Remember, while buying stocks is simple in concept, it's important to do your due diligence, especially regarding the companies you invest in, and be aware of the risks involved in the stock market. If you're unsure about the process or need personalized advice, consider consulting a financial advisor. Segment 5. Stock market indices. Ever heard of the S&P 500 or the Dow Jones Industrial Average? These are stock market indices that track the performance of groups of stocks. Understanding them can help you catch market trends. Segment 6. Risks and rewards. Investing in stocks comes with risks, including market volatility and the potential for losses. But it also offers rewards like dividends and capital appreciation. We'll explore both sides. First, let's clarify our terms. Risk refers to the potential for loss or uncertainty in an investment, while reward represents the potential gain or benefit. In essence, it's the trade-off you make when making financial decisions. In the world of finance, there's a fundamental principle: the higher the risk, the greater the potential reward. Conversely, lower-risk investments tend to offer lower potential returns. This principle forms the basis of many investment decisions. Understanding your risk tolerance is crucial. It's a measure of how much risk you can comfortably handle without losing sleep. Factors like your financial goals, time horizon, and personal preferences play a role. Achieving the right balance between risk and reward is key. If you're too conservative, you might miss out on growth opportunities. On the flip side, excessive risk can lead to significant losses. It's about finding your sweet spot. Different investments come with varying levels of risk and reward. Stocks tend to offer higher potential returns but come with greater risk. Bonds, on the other hand, are generally lower risk but offer more modest returns. Diversifying your investments is a strategy to manage risk. By spreading your money across different asset classes, you can reduce the impact of a poor-performing investment on your overall portfolio. There are ways to mitigate risk, such as thorough research, setting stop-loss orders, and having an emergency fund. These strategies can help protect your investments in turbulent times. In conclusion, understanding the balance between risk and reward is essential in making sound financial decisions. Remember, risk is inherent in all investments, but it's not something to be feared. It's a factor to be managed. By assessing your risk tolerance, diversifying your investments, and using risk mitigation strategies, you can strike the right balance on your path to financial success. Diversification is key to managing risk. We'll talk about creating a diversified portfolio by investing in different types of stocks and assets. Segment 7, Fundamental Analysis. To make informed investment decisions, you'll need to understand fundamental analysis. We'll cover how to evaluate a company's financial health and future potential. Segment 8, Technical Analysis. For those interested in short-term trading, technical analysis is vital. We'll delve into chart patterns, indicators, and strategies for timing your trades. Segment 9, Investing Strategies. There are various investment strategies, like value investing, growth investing, and dividend investing. We'll explore these approaches and help you find your investing style. Segment 10, The Emotional Side of Investing. Investing isn't just about numbers, it's also about emotions. We'll talk about common psychological traps and how to overcome them. Segment 11, Long-term versus short-term investing. We'll discuss the differences between long-term and short-term investing, and why your goals should dictate your investment horizon. Segment 12, Common mistakes to avoid. To succeed in the stock market, you need to avoid common pitfalls. We'll highlight some of the most prevalent mistakes and how to steer clear of them. Whether your goal is financial security, wealth building, or something else, the stock market can be a powerful tool to help you get there. Thank you for joining me on this adventure, and I look forward to seeing you on your path to financial success.